Hello, everybody. My name is Paddy Carter. I'm the Director of Research at British International Investments. And today we are having what will hopefully be the first of a series of impact seminars hosted by the Private Sector Development Research Network, which is a network of DFIs and some research institutions. The idea behind it is to put researchers in contact with practitioners who might do something differently as a result of reading their research, and from the other perspective, to give practitioners and investors access to research that is going to change what they want to do as impact investors. And today we are extremely lucky to be joined by Professor Jonathan Robinson from the University of California, who is going to tell us about the latest research on the impact of digital credit in low-income countries. And I think that's enough for me. Oh, no, it's not. I have to say one more thing, which is about questions. So we are expecting quite a few people. So I think the best thing to do it would be to use the Q&A function in Zoom, please. And then maybe I will gather them up and direct a few at Jonathan. If we get lots, if we don't get too many, then I will call on the questioner to speak. I think we can do that. Okay, that'll do from me. Over to you, Jonathan.
Thank you very much for the introduction. Let me just open up slides. Does that look okay?
Yeah, that's good, Jonathan.
Okay, great. Just navigate here. Thank you very much for the opportunity to talk today. What I'm going to speak about today is a recent recent review that we've implemented, looking at some evidence on digital credit, and this is joint work with David Sung-Ho Park, who's at the KDI School in Korea, and Joshua Blumenstock at Berkeley. And so the format of the talk today will be kind of a higher level summary of several impact evaluations that have been conducted on this topic. So my background is as a professor of economics at UC Santa Cruz is largely in doing field experiments and randomized controlled trials in mostly in Africa. And so the research that we are doing as part of this review is coming mostly from randomized controlled trials or other similar sorts of designs. So there's a huge amount of evidence on this issue, but what we're really going to be talking about is a small set of impact evaluations which have been conducted recently. So just to give an overview, I imagine that maybe this audience is well familiar with this topic, but nevertheless, for those that are not, it's just that the entire initiative that I'll speak about in this evidence-based is based on the reality that digital credit has expanded dramatically in the past set of years. And I'll talk a little bit about that in a second. So digital credit has been characterized as being instant, automated, and remote. And so the idea there being that digital credit can be dispersed immediately with absolutely no delay, potentially. There's no need for interaction with a loan officer or other intermediary, and it can be dispersed electronically in principle at any point on the globe instantaneously. And so in environments like rural Africa, where I've done a lot of work, these sorts of issues could be revolutionary, really, because the cost of accessing a local market or a bank could be quite high for a remote farmer. And there could be a really serious need for liquidity in a short amount of time. So a lot of times in academic research, the research is motivated out of maybe an academic question or testing a specific theory. But in this case, in the studies that I'm going to talk about, it's really motivated by the prevalence of this institution, this new product and how much this has expanded in recent years. And so it's really meant to be a very policy relevant set of studies here, which are trying to quantify the effect of digital credit based on the idea that it's expanding rapidly already, and we don't know a whole lot about what effect it's having on people. Okay, so this is just a little figure about to summarize those three elements of digital credit: that it's instant, automated, and remote. And just to highlight that these costs, the costs of waiting, for example, moving loans from days or weeks to instantaneously, and the third point there about moving from in-person interactions to remote could be particularly revolutionary to in areas in which transportation costs are high, and short-term liquidity needs are serious, like in the case of unexpected emergencies and so forth. In the middle piece there about human judgment versus an automated algorithm, one of the key things about digital credit in Africa and in other developing countries is that it uses non-traditional data, typically things like mobile money usage or utility bill payment, things like that, in a way to provide credit scores that for people that don't have any digital footprint or financial footprint whatsoever. So we'll talk in our review about a couple of different types of products. So several of the studies in the review are based in Africa, and in Africa, one of the more common forms of digital credit is on the far left here is bank telco partnerships. So these are linkages between formal banks and telecom networks, where the bank is making use of the mobile money network and distribution system to disperse loans. And in Africa, at least, these are the most prominent and well-known products. So the most famous in sub-Saharan Africa is called M-Shwari, which is in Kenya, and that's of this form. Well, there's one other that will be talked about in our review. So that's a very important form of finance there, not necessarily in other parts of the world, however. A second form is a bank fintech partnership. And so there are many examples of this. The ones we're most familiar with are in other contexts, such as China. So while that's an important form of digital lending, it will not be as prominent in the studies that we've conducted so far. A third type is non-bank fintech, which are loans just made directly from a fintech firm who has developed an app on a phone. A lot of those are using smartphones, and there are several of those in the developing world as well. And then finally, the most common is really airtime loans. So there's a big market for people taking out loans, advancing credit on their phones, which are paid back. Okay, so I talked a bit about these bank M&O partnerships, but the really key thing here is that the interest rates, when annualized especially, are extremely high. So to take M-Shwari at the bottom, the most famous and the highest impact financial product, there's a 7.5% per month facilitation fee, which annualized over a 12-month year is going to be extremely high. Of course, these loans don't really function that way. They can be rolled over. Many of them are rolled over several times and then are eventually in default. But nevertheless, these are quite expensive forms of credit from a developed country point of view. In general, these loans are for small amounts of money. So M-Shwari does offer loans up to about $100, but in general, they're very small sums. And the credit scoring on these is using mobile money transaction data. Okay, the non-bank fintech products, a lot of those are based in Santa Cruz, California. Not far from here is Silicon Valley, and a lot of these are based in that area. So two famous examples are Branch and Tala, which provide loans to smartphone users in several countries. The interest rates on these are more heterogeneous, and I think some of the rates can be lower, but the introductory rates are can still be 10% or more per month. And then bank fintech partnerships, which are not as much of a focus, but are of our review just because it's based geographically in certain areas. These are very prominent so some of the biggest digital lenders in the world are characterized this way. So WeBank, for example, and these are much more successful and have a much larger base than many of the products currently being offered in the developing world. So for example, WeBank, we had estimated has something like 28 million users and a large amount of loans being made in a given year. And these are interesting to look at later on in terms of an example of a successful product that has been scaled up. So what we're gonna just talk about briefly in the limited time I have here is just the question of does digital credit help or does it harm borrowers? So from an economics 101 perspective, digital credit has potentially major positive effects in the massive reduction in transaction costs, in the ability to provide credit to people that are excluded from the financial system as of now. And then an important point is just that one thing that's very clear and what motivates why this research was even done is that there's a huge amount of demand for these loans, suggesting that people are severely constrained and are willing to take out loans at these high interest rates. So from a revealed preference point of view, that an economist would think that means that people value these loans. Okay, on the other hand, there's a lot of reason for harm and a lot of reason for concern. And I think a lot of observers of this industry focus on the harm more than the help, probably. I think the biggest concern is that people are uninformed about the loans that they're signing up for. And I'll show some evidence that people indeed have very little information on what exactly they're signing up for. And default is quite high. There's one study that I conducted personally, which has an enormous amount of default and people are uninformed. And so if it's the case that people don't know what they're getting into and are not paying back on time, then that can be harmful to them. Another point that's important is that impacts we would expect to be heterogeneous almost certainly, because there are certain people, because the thing about digital credit is the reason why it could be so amazing is that it's so easy to get the money, but then on the other hand, that's exactly why it could be harmful. So certainly some people are going to benefit from the increased access to liquidity, but others potentially could be harmed if they use the money for purposes that are not productive, or it would be better off with some amount of waiting time. Another important point is that the effects are going to depend very centrally on how costly is default. So in a country like Kenya, it's been reported that millions or even more have been reported to credit bureaus. In other contexts, credit bureaus aren't functioning as well, and people may not get credit anyway. So it's an important question as to how harmful that may or may not be. Okay, so in the interest of time, I won't get into this too much, but I would say that there's, especially several years ago, there was a lot of interest in the harmful effects of digital credit, like around 2019, 2020. And then I think a lot of attention in the academic community has gone to cash transfers at this point, after all of the cash transfers that have happened as a result of COVID. But there have been some famous examples of negative effects. One of the most famous ones being in India, where people were downloading apps from the Google Play Store, and then a lot of those apps were banned for being predatory. A recent study suggests that about 1/3 of the apps in the Google Play Store are predatory in developing countries. So what this all brought about was the creation of something called the Digital Credit Observatory, which was started in 2016, funded by the Bill and Melinda Gates Foundation, I'm co-director of that with Josh Blumenstock, and CEGA has funded 17 research projects on digital credit, and I'll talk, not all of these successfully found impacts, but I'll talk about what evidence we do have. Okay, so the evidence we have are, we have 8 completed studies, and they don't have the bank fintech partnership, but otherwise we have some that are bank M&O, a couple airtime loan products, and a couple of non-bank fintech products. Okay, so in the interest of time, I can skip over some of the details of these products. This table has a lot of information in it, but one of the key things is just the is the fees. So like panel B, the fees and the late payments. So in Surrey et al., which is about Mshwari, as I said, that's about 7% per month. Okay, and then the study that I had done with, which is Brailovskaya et al., the interest rate is actually 10% for 2 weeks, and after that there are serious late fees. But so just in general, the interest rates are very high. Those are not framed as interest rates by the lenders. However, they're called facilitation fees. Okay, airtime loans. There's 2 examples of these. And again, the key thing is just that in panel B is that the fees are very similar to the bank M&O loans. So people are taking out loans for airtime that they were going to purchase anyway, that the default rates on these are extremely low because people are paying it back out of their next recharge, and those interest rates are very high. And then finally, the non-bank fintech products, these also vary, in their interest rates. Some of these are higher and some are lower, but in general, feature high rates. Okay, so I'll just have a few minutes of some data we have on what we learned from this. Okay, so the first thing is that, as may not be shocking, is that the people who are targeted by these products are definitely highly positively selected on income and on being urban. So without getting into every number in this table, one of the key things, if you look at the age, for example, or the percent of the population that's urban, or the years of education, so the average age is about 30. The proportion of people that are urban is, ranges from 20 to 70%. And the years of education, is often over 10, which is very much higher than the country averages for a lot of these. The one I know best is Malawi. So the customer base for this are much more affluent, urban, higher income individuals, which is interesting in the sense that even those individuals are willing to take out loans at these extremely high rates. Okay. A second fact is that in these studies, one of the nice things about the studies is that by having a sample that's offered digital credit, we can just measure simple things like how many people are actually interested in this out of the entire population that's offered a product. And we find quite high take-up rates. So I think one thing that a lot of people think is that this is similar to microcredit. And it is in a way, but these take-up rates are quite high, I think, because potentially digital credit can go out to millions of people subject to funds. But the take-up rates are in the M&O bank ones, for example, is like over 30%. So potentially that's millions of people that are willing to take out loans. So that's just one dramatic way in which this could be very different than microcredit. Okay, the loan sizes are small and the default rates are definitely not zero. So the default rates range from 7 to 15% in what we find with the exception of the airtime loans, which are much lower, and with one product that was targeting agents rather than individual lenders. So what we were primarily looking for in these studies was to look at what's the effect on people's livelihoods. We really only have 3 studies that were able to do this for various reasons, but there are 3 main ones. There's one that's about Mshwari in Kenya. There's the second that's about Kuchova in Malawi, which is another M&O bank product, and then finally there's one that's a smartphone app. And so what these find, this result may seem as underwhelming or shocking, depending on your point of view, is that essentially all these studies find some evidence of some small positive effects on certain measures like self-reported financial well-being or other soft measures like that. Very limited evidence on anything else, but no evidence of really big negative effects, which for many people is surprising. And we can talk about that in the Q&A as to whether these products are, better than average or what have you. But for the most part, we actually do not find big negative effects, though not big positive effects either. Okay, a second finding, just as I motivated, was that people are not aware of the loan term. So in the study that we did in Malawi, we found that only about a third of people were aware of what the interest rate was, or even the fact that there are late fees, let alone what they were. So in that study, we targeted out an interactive voice response intervention to inform people about the cost of credit. And though we didn't push people one way or the other, a lot of the emphasis was on how expensive the loans were and about how perhaps savings would be another option. We found very counterintuitively that this actually increased demand for the loans rather than decreased it, which is what we expected. When we look more at the financial lives of the people in our study, it's not as surprising because the loans that people are receiving from other sources, even savings groups that they have, are also very high interest rate. We found that intervention decreased default, at least in the short term, as well, which suggested an interesting possibility that financial education could actually be profitable for the lender as well. Okay, so just have a couple more slides, a little bit over time, but a second important point is a study by Burlando et al. in Mexico, which use a design to try to look at the effect of having to wait a longer period of time to get a loan. They find amazingly that having to wait longer has a higher repayment rate. So getting the money later is better than getting it faster in terms of repayment. They don't know necessarily if this means that people had to skip some important expenditures in the meantime, but it's an interesting fact that in some ways maybe the digital credit is too fast. So just to wrap up what we have so far is just that it's just to restate some facts that are maybe obvious once you look at it, which is that there's incredible demand for these products. We don't know too much about the impacts, so we've started to fill that gap a bit, but it's still a lot of questions remain. But on the whole, we find what we would expect is kind of a surprising result, that we don't find major negative effects so far. So the questions that remain then are, first of all, there's clear need for customer knowledge and consumer protection type initiatives. A second kind of elephant in the room is just that the products that are being studied are just not by their very existence are not going to be effective for the types of investments that people really want to enable, like paying for school fees, or investing in education, or investing in the farm or in the business, because the loan repayment is too short, the term is too short. So there's some interesting ways of expanding digital credit to something more robust, but that hasn't been done yet. In addition, the credit scoring that has been seen so far has been pretty rudimentary, I would say, and so kind of more work in that area in terms of trying to target impacts, or to look at things like gender differentiated credit scoring, and then heterogeneity is a point that I've raised. So my last slide is just to say that where the DCO stands is that we've currently funded another round of projects that are trying to answer those questions. There's two main parts. One is about additional impact evaluations, and the second is about data privacy. And so I can talk more about that in the Q&A perhaps, but maybe this would be a good point to stop for questions. So thank you.
Thank you very much, Jonathan. We have one question in the chat. Oh, and there's someone in the Q&A. So I encourage you all to get to your keyboards. And whilst you're doing that, I've got a couple of questions that I had in mind. So I'll if you could sort of if I could park those with you, Jonathan. So with the microfinance literature, as I understand it, people are thinking, well, there are some borrowers that have a business and they have some way of turning a loan into, increased revenues for them, and their incomes go up and they get growth, but actually like there's only about like 5% of borrowers or something like that that do that, and most people that are borrowing from microfinance are not doing that. So are you getting anything from these studies about like how many of these borrowers have a business and they are using the funds to invest in that business, or are you really, we're not talking about that at all because these sums of money are too small and the repayments are too quick? On the chat, my colleague Claudia was asking just whether you knew anything else about that result, that having to wait a bit longer increased repayment rates, and whether there was any sort of kind of ideas about what was behind that. And then okay, and then interest here in whether there's any more to say about this positive relationship between financial education and profitability, because as you are speaking to an audience of investors, that one is obviously going to be piquing everybody's interest. All right, thanks a lot.
Thank you. Thanks. Yeah, these are great questions. So for the first question, as I understand it, which is about whether there's a subset of people who might be able to use these loans for productive purposes. So in the study we have in Malawi, we know what people use the loan for, and a lot of it is things like buying food or other things of that sort. So there, I believe, I need to look at it again. I believe there are some people who do report using those loans for productive purposes, but I think what you said in your question, that the loans are just in general, the term is so short that it makes it hard for that to be the purpose, I think is correct. So I think there might be some, so in general, the point that like microcredit might have benefited a subset, and that this could be similar, is a valid one. Nevertheless, I think it'd be interesting I think some of the products that would be interesting to evaluate are more value chain finance or other sorts of interventions that more directly target, because these are really consumer loans that like could be used for that purpose, but they're not really designed for that. So one of the studies I glossed over was about providing loans to mobile money agents rather than to end users. So mobile money agents are the people who are dispersing these sums at shops and so forth. And so for them, it's like a very low risk loan because they have large amounts of cash flow, and that's all coming through on the network that can be seen. And so that product was offered at a much lower interest rate and had a low default rate. So I think perhaps some product innovation in that sense would probably be the most productive way forward there. But that's an interesting point. I think these studies, as it stands, don't really have power to really speak to that, because, like as you said, if 5% of people are benefiting from these loans for productive purposes, and it's 5% of a small sample already, it's hard to see that. So the second question about the longer waiting times, it's an interesting question. So it's a very neat study by other colleagues of ours within the SIGA network, which is based on the West Coast of the United States. So I know that study well, though I didn't participate in it directly. And so what they have only is administrative data from the bank on repayment rates, and the repayment times is not random, but is due to the way that they batch the loans at the end of the day. So all they know is that the default rate is lower a day later, and so one could conjecture that that's because some of the money is being spent on not essential purposes, and that people have trouble paying those back, and it might be better to not get the loan. It could be that, on the other hand, that people deliberate more over what the reason for the money is. Unfortunately, there's not really an answer to that question. So I think it's a very interesting study, and requires further work to really understand exactly how that happened. Unfortunately, and yes. So then there's the question about profitability and the financial education. So what exactly we did there is we did a short financial literacy module through another partner. So we had access to these to possible lenders' cell phone numbers from the lender, but it was done by a third party. And so what we found was that providing the loan, doing the interactive voice response actually increased demand and decreased default. So kind of win-win for the lender. So one thing we did find, however, is that over time, because people are taking out more loans and they're defaulting less, but they're still taking out more loans, that like eventually they're going to default. And so we did find that in the long run that defaulting at least once is higher in the treatment group. But that's what we have there. So potentially, you know, kind of paradoxically to those who are concerned about it, that having consumers be better informed would be beneficial, because a lot of what, surprisingly to us, like what a lot of, you know, though we've done work in Malawi for many years, but and have done work in a lot of work in savings and have done some work in credit as well, but it's still, nevertheless, when you just do a survey of what people's loans are from different sources, it's just some of these institutions that people point to as kind of pro-poor or inclusive institutions such as savings groups actually offer interest rates that are 10% per month or more as well. So so when people like look at their different products, like an interest rate of even 10% for 2 weeks doesn't seem so daunting. So that's our result there.
So I have another question, Jonathan. This is all right. So I think I'm being a bit oversimplistic here, but one response to the evidence that emerged from the microfinance industry was that people might have said, okay, so this isn't about lifting people out of poverty or kind of income growth. It's actually a consumption smoothing story. So like the rationale that impact investors might have cited for supporting these institutions sort of flipped a little bit. Part of impact investing is impact reporting. And I think that we all understand that if we were able to report that borrowers increased their, you know, annual income by a certain percent or a certain number of dollars, that would be a reasonably easy thing for people to understand and make some sort of sense of. But consumption smoothing is much harder. Has the economics profession kind of come up with a way of, I guess, valuing consumption smoothing? How important is consumption smoothing and sort of risk coping set against things like just getting better off?
Yeah, that's a really great question, because yeah, I think that the risk coping thing is definitely like the channel that you could see as like, I think that probably that's what people would point to as like the number one way in which this could be beneficial, is that you know, so there are horrible examples that everyone can point to of things like you know, a child is sick and the money is needed immediately, you know, so waiting a day, you know, for malaria medication is going to be disastrous. And so that seems like a real channel in which the instant automated and remote framework is going to be hugely impactful. And so the first study, the one about Mshwari in Kenya, that's the main effect that they do find, which is about risk coping. And so the way they look at that is they look at like all the shocks that people have encountered, just asking about a long list of different types of shocks, and then like what did they have to do to deal with that shock. And so their main result is that people are less likely to have to reduce their consumption in response to a shock, because they're able to use this source of funds to smooth it over. So there are techniques to deal with that, which are doable, definitely, but are very hard to actually implement, because typically it would require having like a time series or high frequency information on people's livelihoods, and to look at what happens in bad periods. But on the other hand, the evidence base from these three studies is far from clear, because our study in Malawi definitely found no evidence of that whatsoever. So when we ask people about the like just basic descriptive stuff about like what they use the loan for, it really wasn't for dealing with emergencies in a huge amount of cases. I mean, so it was like about 10% of the loans were for that, but it's not going to be like, so I guess an overarching issue is that these studies are, in general, RCTs are great at identifying causality and those sorts of questions, but on the other hand, tend to be very small scale because the surveying is so expensive. So we probably, so this issue about trying to identify these people who are benefiting is similar to your previous question about the people who are benefiting from the business investments. Perhaps we just haven't, it's hard to zone in on them, but in principle, like in general, there's a little bit of evidence that these products are beneficial for consumption smoothing.
And there was a question in the chat, I think you've indicated you'd like to respond to, Jonathan, or the Q&A.
Yeah. So the question about lifting people out of poverty, that's a great question. So the basic issue is just that these studies, so the impacts that we find in these studies are just too small to have effects on things like ultimate livelihoods. And then another important thing that I kind of glossed over, but I think is really important, is that these products are not being targeted, of course, to lift people out of poverty, but are instead out of profit motive. And the customer base are not poor, really, because just, you know, basic issue is that people don't have phones, of course, like the poorest, and then on top of that, they're being scored based on their mobile money usage, and so poor people are just excluded by definition. So there has been some interesting evidence that maybe some people may have seen about the impact of mobile phones and mobile money on poverty. So several of the authors of the earlier Mshwari study had done a study about mobile money in Kenya, and that had actually shown some effects on poverty. But for the types of interventions that are done here, they are small amounts of money, and in general, probably are not going to have effects like that at the current time, anyway.
Thank you. So I've got a couple of questions which are probably going to rely more on your anecdotal knowledge of the what's going on, and less on sort of rigorous studies. And then I just note that Patricia has added a question to the Q&A, if you could take a look at. So one question I was going to ask was whether you see signs that, you know, certain lenders are really raising their game and are noticeably better on things like customer protection and kind of good information about what you're getting into when you click apply on your mobile phone to get your loan. And then the second was to sort of even ask you to speculate a little bit about how you think the future of this industry might evolve, and perhaps in ways that might make it more interesting from a development and impact perspective. And I'll stop there, and then there's Patricia. Thanks.
Yeah, it's a great question. So one of the problems for academics is we have very detailed information on only those things that we've looked at. So it's so one thing we were chatting about before the session is that if, for anyone who's interested, there are other reviews as well that are cited on this paper, which is on my website, that speak to a much broader set of questions. So what I know within our own context is limited because we just have these several different studies. Unfortunately, it's an interesting question. I mean, so what I know is that it'd be interesting to look at what the disclosure policies are in what the disclosure laws are in different countries and that sort of thing. So anecdotally, you definitely hear that. You rarely hear information about people being very well informed about the loans that they're taking. So there are a lot of different kind of descriptive studies about, say, doing mystery clients at mobile money agents, and to see what is told to people when they take out a loan. And a lot of the evidence is they're told very little. But it's an interesting question as to whether there are contexts in which it's not as bad, and that would be. But I'm not totally familiar with that, unfortunately. And then in terms of the future of the industry, that's a great question. I've definitely thought about a lot of us have thought about what's the future of kind of products that could be impactful for individual for households and for firms and things for small firms and things like that. So, for example, there's been work about digital collateral, about providing, especially with products like solar panels or other things that have a flow benefit, in the sense that so a solar panel that could be sold to a rural customer is generating some amount of revenue every day in terms of reduced fuel consumption and just the benefits of having a phone charged and things like that. And so, for example, there have been some research about, so potentially you could, using technologies, you could lock people out of this technology if they're unable to pay, which can make it possible to make this loan of something that's actually clearly valuable for customers and in a way that could be profitable. And so that there are many firms that are doing that sort of work that seems like in general could be more impactful than the types of products that we've studied. On the other hand, the products that we've looked at are not, these are not geared towards moving anyone out of poverty, but just about generating revenue. And these have been incredibly successful at doing that. So I'm not entirely sure, but if we look at countries like Kenya, which have had a more developed mobile money situation in the first place, and we look at the products that are offered, there's just proliferation of these sorts of different short-term consumer loans that are being offered. And I actually don't know enough about the context to understand about like what other types of products are there at the moment. But perhaps people in the audience have more of a answer to that.
Patricia, if you're there, I don't know whether what Zoom is allowing people to do, but can you come off mute and maybe give your question verbally? I don't know why I didn't think of saying this before. Oh, there you are. Let's see if it works.
Hello, can you hear me?
Yeah, we can.
Oh, great. I thought it didn't work. Thank you, Paddy, for allowing me to make my question, and thanks for the presentation. You mentioned in your talk that one of the promising areas to improve the benefits of these products of digital credit was providing more information. And one very interesting finding that you mentioned was that in one of these studies, providing this information led to these improvements in repayment in the short term. I wanted to ask you if you could please elaborate a bit more on how this intervention was designed, what type of information you provided, and how it was provided. If you could guide us a bit on that one. And if you had now the opportunity of conducting further experiments or studies on this front, what are the areas where you think we should be looking at if we should think about different ways of providing this information, or different types of information that you hadn't tested in the past that you think would be useful to keep in mind in the future? Thank you.
Yeah, that's thanks a lot. So our intervention was definitely based on the so there'd been a study that had been done some years ago in the United States, informing borrowers of a not digital, but a payday loan of a payday lender about the costs of borrowing repeatedly at very high interest rates. And so our intervention was like largely based on that, and it focused so we didn't really take a stand on whether taking these loans was a good or a bad idea, but it was kind of like walking through a calculation of how much it's going to cost to take out a loan. So what it was an anecdote of a business owner actually who was restocking, and we went through how much it would cost to take out a loan and what would happen if you paid back late, and what the interest rate was and so forth. And so we didn't really take a stand on what people should or shouldn't do, but I would say on the whole it was pretty negative about taking out the way we looked at it was definitely that it was making very salient the costs of taking out the loan. So so that's why we were surprised that it actually increased demand for the loan. So in terms of what would be helpful from that is that that intervention took about like 8 minutes to do on IVR. And so if we had more time, I could talk about how proud we were about how we were able to get people to actually do that module with a small incentive and repeatedly contacting them about doing it. But so we got about 50% of the people in our study to actually do that. But I think that if you really wanted to get the core information out to people, it seems like that could be done much more cheaply. We had other interventions where we'd actually tried out a lighter touch intervention where we just texted people information on the loan terms. That actually wasn't effective. So there's some balancing act there between providing them with the key information, which I think is just about what the ultimate cost of the loans are. We had also talked about the possibility of being reported to a credit bureau, but they, according to our partner, that actually doesn't happen. And maybe people do. It's unclear how much people care about that. You would think that they would, but on the other hand, if they're not getting access anyway. So I think in terms of where you go from that, I think if people were really, if a lender was really interested or a government was interested in that, I think that the starting point that we had was could definitely work. It's just a matter of a lot of people aren't going to be interested in taking an 8-minute financial literacy quiz like that, or training like that. So there'd have to be some work in terms of like honing that down. But with that, and also the waiting time one, I think that there's 2 hints there about possible interventions that could be beneficial. So the waiting time, the key thing that was already brought up is, the key question was already brought up is like, well, what was the cost of having to wait? So we see that the benefit was the higher default rate, but what was the cost? And that's what we don't know.
This might show how naive I am, but I'm almost a little surprised that you aren't required to do a little how interest rates are going to work and how charges are going to work before you are allowed to click I would like a loan, please. Do you see that there are a few more questions? Jonathan, are you okay picking up questions live off the Q&A now? You can see, is that working for you?
Yeah, sure. Yeah, yep. Absolutely. Okay, so there's a question about the products that are from pro-poor loans versus the digital loans in developed countries. So if you don't mind, do you have a sense of like what kinds of pro-poor loans you'd be thinking of?
Are you able to come off mute, Shubranka? I think we should be able to hear you now. Shubranka,
yeah. So by pro-poor, what I essentially wanted to mean is not essentially pro, maybe it's not the right definition, but generally the tendency of loans being very, very short term and high interest, if I take that qualification, which is most predominant in the developing countries, comparing that with the developed countries.
I see. Yeah, no, that would be an interesting question. Like, so I think one of the things that's complicated is how to conceptualize like the difference in these different products and how to compare them. But I think that would be potentially an interesting question, because the loans, for sure, the digital loans are definitely not intended to have any sort of poverty alleviation effect or anything like along those lines. So these lenders were happy to work with us because they, regulators and others are, so for example, the partner we worked with had recently had some, scandals about information disclosure. And if you take a look at our paper, actually, there's a whole, in fact, the late payments are actually not disclosed correctly whatsoever in the terms and conditions. It's pretty shocking. We thought it was pretty shocking anyway. But I think it'd be interesting to, like, it's definitely an interesting question, because that's not what these loans are for at all. And it's just about profit, unsurprisingly. And so that could be an interesting thing to look at. I mean, as it is right now, it's really more like there are loans that are being offered that people are willing to take up, and does it hurt them? or can it possibly help them? But it's not really about, I think what would be very exciting would be to see loans actually being made for more of a, like, as you put it, a pro-poor sort of motivation.
So I know it wasn't the focus of your talk, Jonathan, but you did briefly show us that in some of the more middle-income countries, there are, fintech businesses doing bigger loans at lower APRs. So the annual interest rate didn't look too outrageous. So what's the evidence coming out of that in terms of the impact on people's lives? Does it look qualitatively different from what you've told us about today?
Yeah, that's a great question. There's not good evidence on one way or the other. If you talk to people about their experience with those lenders who've taken out loans, no one's too excited about that. Like, so their co-author's Korean, and many friends of his are taking out loans like that. And in general, I think people's anecdotal evidence is just like a convenience thing that people are doing. But it would be very interesting it would be great to know that, but we don't have evidence on that. So one of the reasons why we've studied these certain contexts is because, of course, we're interested in that, but it's also the case, like in the case of Malawi, it was possible to do this because the market is so underdeveloped that it's possible to do a randomized controlled trial because nothing is existing. It's much harder in a more developed market. So that's an important open question. It's a very, I haven't talked about this at all, but like, it's not even that clear that these products are profitable for the lender in the first place. I mean, the default rates are, the interest rates are extremely high, but so are the default rates. And so a lot of these products are coming and going all the time. And so those contexts are very important to study because they're an example of products that are clearly sustainable and could be successful from that point of view, but we don't know really.
Well, thank you very much. I mean, you started actually by saying that, I guess what the right way of putting this is, in the circles that you move in, let's say, there was an expectation that you might find that these products were pretty harmful. So you were almost pleasantly surprised to find a kind of a null effect. I think maybe in the world that some of us on this call move in, we are maybe more prone to thinking that, financial inclusion and, things that touch, now, I know that you say these aren't particularly pro-poor, but we might be using the word poor in different ways here because a lot of people use like 190 poverty to use poor, but for those of us that invest in formal sector firms, we are quite often naturally a bit higher up the income distribution with how we understand whether we're reaching poor people. But that said, so we might have an expectation that these things are going to be more impactful than you found. So I think you are challenging us by showing us that this particular type of lending isn't necessarily having a terrific positive impact on people's lives. On the other hand, the potential to improve that with better education and kind of transparency about terms and conditions, and the fact that that might even make this business more profitable is a very interesting finding for us. So I know we've got 5 minutes left, but it does seem like we have exhausted the questions. So unless anybody's going to make a last-minute intervention, I think I will.
There is one other question. If we have
there is. Oh yeah. Okay. Yeah.
Yeah. So there's a comment about do state-sponsored cash transfers could those expand access to these sorts of digital loans? And that's a great question as well. And that's something that would be interesting to look at. As it turns out, in the context of some of these studies, they received almost nothing from in the country of Malawi, provided very little. But that's a great thought that potentially could work very well. And so there's some interesting work that my co-author Josh Blumenstock has done on targeting those sorts of COVID payments and other payments. But kind of integrating that with digital credit would be a really interesting thing to do. But that would be a perfect example of something that you could use as credit scoring that could be beneficial. Absolutely. I'm not sure that there's a lot of evidence on that, but that's a perfect example of where digital credit could be beneficial.
I apologize, Lena, for overlooking your question. Okay. Well, I'll try again. Any last-minute interventions, or all that remains is to thank Jonathan for getting up in a very uncivilized early hour in California to talk to us all today. Thank you very much, Jonathan.
Thank you. I appreciate all the questions too. Thank you so much.
Okay. Goodbye, everybody.